Good morning, and thanks for joining us again for Tecnoglass quarterly calls. Again, a very strong quarter. Happy to report that we were able to produce revenue growth north of 15%, 15.4% year over year, with both segments contributing nicely at a double-digit pace, especially single-family residential going up 21%, commercial going up 12%, and with the momentum continuing, with order levels as of Q1 up 16% year over year, which should translate into a nice revenue for Q2 and beyond. That gives us very nice visibility to reiterate our guidance and narrow the ranges. We'll talk about that here in a little bit. From a gross margin perspective, it was a nice quarter over quarter pickup of 520 basis points. We got the benefits of pricing, which was put in place, price increases that were put in place at the second half of last year. We got operating leverage, and we got help from a mix perspective. So it was nice to see all contributing factors there. Adjusted EBITDA up 38% from 51 million to about 71 million, so nice pickup. Record free cash flow of 29 million, so the company continues to generate a healthy amount of free cash flow, which is helping us continuing to deliver, and now at a pretty healthy net cash position. Again, record backlog north of 1.1 billion, up 25% year over year, giving us visibility into 2026 and building into 2027 now. So that's nice to continue seeing, which helps us transition into the backlog slide, where we're basically just seeing continuous strength in our main markets, despite the choppiness in terms of multifamily starts and permits. Our main markets, specifically certain pockets in Florida, continue to do well, and Tecnoglass continues to gain market share as a whole. Not to mention our expansion into different geographies, which is also helping fuel some organic growth, which is not necessarily seen in the industry as a whole. On the next slide, we see that the backlog typically converts 2/3 in the following 12 months and fully in the following 18 months. Right now, the backlog composition has a lot more large projects that are multi-year in execution. So we are expecting to have visibility farther out and not necessarily having to execute those projects as quickly, but more extended over time. From a single-family residential perspective, on the next slide, we continue our geographical expansion. We now have another showroom that is operational in Phoenix. We continue our vinyl ramp-up, which expands our target market significantly. And we just launched our legacy aluminum window line, which is designed for other geographies like the Southwest. So that gives us a few other avenues for growth, which gives us confidence on the guidance for 2025 and building into 2026, despite all of the macro factors, including tariffs that we're going to discuss here in a little bit. From a revenue perspective, on the next slide, as mentioned earlier, we were able to experience double-digit growth on both segments. Single-family residential performed extremely healthy. And as a reminder, 70% of what we do on the single-family residential front is more related to repair and remodeling, not necessarily new home construction. And obviously, we're being the benefactors, again, of being in markets that are operating in a healthy way, being the benefactors of the fact that the locked-in effect continues to be in place, where people are not moving into new homes to keep their current low mortgage rates. And again, the fact that we're growing organically into many different geographies, with 5 showrooms open and another one planned for Los Angeles later this year. Our end markets are outperforming some other geographies. And what we want to do is obviously to diversify as much as possible. So in 2, 3, 5 years, we expect the company to be much more diversified away from the Southeast, which is currently our main market. From an adjusted EBITDA perspective, we were able to gain margin going from 26.5% in the first quarter of 24 to 31.6% in the first quarter of 25. That was obviously helped with the gross margin pickup, which was derived from incremental volume, operating leverage, and a healthy, tailwind on FX as well, where the Colombian peso devaluated 7% quarter over quarter. And to that extent, we were able to be opportunistic and hedge a large portion of our FX expenses for the rest of the year at a rate significantly higher than last year and at a rate higher than we had originally budgeted for 2025. So that's also helping us offset some of the tariff impact that we're going to discuss here on the next slide. From a tariff perspective, we had mentioned in the first quarter of 25 that we had already taken some decisive actions to proactively mitigate the impact of tariffs to our business. We're quantifying that to be about $25 million for 2025. And we're mitigating that in several ways. Number one, we already announced pricing adjustments in the mid-single digits range that are going to take place as of May 1st. So the first invoicing will take place in June. So for the second half of the year, we'll have the benefit of incremental pricing. We have shifted some supply chains and should be able to mitigate some of that factor by sourcing different materials from different places. So we're also helping our costs by being able to be flexible and nimble in how we supply raw materials. And finally, as mentioned before, we were able to lock up pretty healthy FX rates or pretty favorable FX rates by doing hedges for the rest of the year, which have helped us secure FX rates that are above our original guidance for 2025. We're also diversifying operations. We announced the acquisition of certain assets of Continental Glass Systems in Florida, and that includes a real estate manufacturing plant in Florida. And that would allow us to diversify production as needed and also help us with tariffs if need be going forward. And this is all aligned with our strategy to be more US-centric and be opportunistic from a logistical perspective and some efficiencies on lead times. So going forward, we'll be able to use those assets as appropriate. Moving forward, the cash flow continues to be very robust. All-time high cash balance at $157 million, derived from a record free cash flow quarter. We're expecting CapEx to drop significantly the rest of the year. So we're expecting a healthy amount of free cash flow to be generated the rest of the year. Q2 typically is a seasonal low free cash flow quarter, given that we make all of our income tax payments in Colombia in the second quarter of the year, as in years past. But with the reduction of CapEx, we're expecting free cash flow to pick up nicely sequentially after that. Finally, we narrowed the outlook, raising the bottom of our revenue guidance to $960 million, maintaining $1.02 billion revenues at the high end of the guidance, which accounts for the acquisition of the Continental assets, accounts for the pricing increase that will take place in the second half of the year, but then accounts for certain volatility on volumes, although as of now, we're not seeing that being an issue, given that order levels were up 16% as of Q1, translated into a healthy amount of revenues in Q2. And we narrowed the EBITDA guidance to $305 million to $330 million at the higher end of that range, based on some variables that we're outlining in our presentation. With that, I leave you, and thanks for joining Tecnoglass call. We hope to see you after we report Q2 again. Thank you.